You all know who Michael Burry is. He's the one who rose to stardom after correctly predicting the mortgage crisis of 2008. Through his short position, Burry has managed to make boatloads of cash as the stock market was crashing. Michael Burry put out a tweet with a single word, "sell" on it, before he deleted it in January 31st. He deleted his Twitter account ahead of the Federal Reserve's announcement of a 25 basis point rate hike, bringing it to a range of 4.75%, the highest rate since 2008. Burry reactivated his account after deleting it to put out a tweet saying this time is different, making fun of investors who have lost money in the stock market and now they think this time around is different and that they'll make money because they have gained experience, when in actuality, these rookie retail investors did not learn a thing from their past failures and continue making the same mistakes and losing money in stocks. Michael Burry deleted his Twitter again after Elon Musk replied, making fun of Burry by saying, "This cracks me up every time." This is not the first time Michael Burry has released a cryptic tweet telling investors to sell their stock before deleting his Twitter account. It's almost tradition now. That's why I was able to find his tweet on a different Twitter account made specifically to chronicle and archive Michael Burry's tweets so everyone else can view them after he's deleted his Twitter account for the third time since last year. The tweets clearly show that Burry wants investors who believe in him to sell their stock because he expects the stock market to turn ugly. He doesn't want naive investors to be fooled by the recent stock rebound where the market saw green for days on end on January. However, for the stock price to rise, you need to put money in the stock. So there were already many investors who were bullish. The reason these investors chose to invest in the stock market in January was because they believe inflation was coming under control. The Federal Reserve was expected to cut interest rates this year. If that happens, the US economy would improve. Company profits should also go up across the board as more people buy goods and services from companies. That is why the stock price rose in January. So why did Michael Burry put out his tweet? Many believe it was because of the rally in the stock market in January. Many stocks were going up in price, even though there were no major catalysts. Tech stocks in particular were rallying. Meta's stock price, which had taken a horrible tumble in the past 2 years, rose. Even Tesla, which had been battered by Elon's controversies last year, regained more than 40% in the markets briefly before falling. The S&P 500 rebounded by roughly 6% in January. To many investors' surprise, Michael Burry compared the S&P 500's rebound to the rebound during the dot-com crash, where the S&P rallied slightly before crashing further, meaning the gains seen by the S&P 500, according to Burry, will be short-lived. He expects the S&P 500 to rise and fall just as quickly. There's been this large divide between investors this year in 2023, with one faction believing the stock market will rise as Papa Powell cuts rates, while the other camp believes the stock market will fall. If inflation won't cool down, rates will remain raised, prompting stocks to continue their freefall. There's a reason why rising interest rates cause stock prices to fall. When interest rates rise, it means it's expensive for companies to borrow cash to grow their businesses. Less business growth leads to less revenue and less profits. Seeing as stock prices are usually based on company profits, lowered profits can cause less investors to invest in the companies, which then causes the stock price of companies to fall. Let's take a look at the divide in opinions between investors at the top of their game. Some prominent investors who think the stock market will rally include Tom Lee from Fundstrat and Ed Yardeni, the president of Yardeni Research. Ed Yardeni is optimistic about the stock market. He believes the falling energy prices, cooling inflation, and a strong labor market will improve the situation in the stock market, and that we've seen the worst in the markets since October last year.
I think we made a low on October 12th in the market. I think that was the end of the bear market, and I think we're back in a bull market. Not straight up, a lot of volatility, but I think the markets are telling us that the world economy is improving.
Tom Lee is even more bullish. He predicts stocks could reach record highs by the end of the year, especially when investors have already priced in a lot of bad news, which includes weak earnings growth they'll see in the upcoming years.
Into the end of the year. So the odds really favor the market strengthening from here, even though people think we're peaking. I mean, I don't know what CPI brings tomorrow, right, but I would say 4,800 is conservative.
Moving on to people who are pessimistic about the stock market, the bears of today who think the stock prices in the market will fall across the board. In Burry's camp, we have Jeremy Grantham, the legendary investor who founded the Boston-based asset firm GMO, JP Morgan's chief strategist Marko Kalanovic, and David Rosenberg, who heads Rosenberg Research. Mark thinks the S&P 500 will fall by more than 10%. He urges investors to stay away from stocks while interest rates remain high. Rosenberg echoes Mark's sentiment as he believes the stock market hasn't hit a bottom yet and that the stock market is still too overpriced. He thinks the S&P 500 will fall by 27% if the Federal Reserve wants to raise rates further to achieve their 2% inflation target. Jeremy Grantham also believes the S&P 500 will crash this year. He expects the S&P 500 to fall to 3,200, which puts his prediction next to David Rosenberg's 27% dip. He believes over the next 2 years there will be a great global property downturn because of weaker growth in company earnings, supported by Jerome Powell's rate hikes, the raw material shortage, and climate change. Michael Burry has been consistent in his bearishness for the economy since the pandemic plunged the world into a recession, and he might be right. If the recession gets worse and the Federal Reserve continues hiking or maintaining interest rates at their current levels, then the stock market might really fall dramatically. After the January rally, we are already seeing it happen slightly. While earnings report this year have not been released yet since the first quarter has to end before we get the reports, and the only other catalyst for companies are their earnings report from Q4 of last year, some stocks, which rallied with the rest of the market in January, have begun to fall. You can see the stock prices rising and falling, curving like an umbrella. So what do you think? Will the market rally in 2023, or will it drop as the weaker economy shutters company earnings and drags the entire stock market down with it? Will Michael Burry's predictions come true? Comment down below. Thank you for watching, like and subscribe.